Welcome to Iron Financial, the only place to forge a stronger portfolio and cut through the market weakness. Today, we are putting Hewlett Packard Enterprise directly onto the microscope. Now, they just dropped what, on the surface, looks like an absolute monster of a quarter. But the real question is this new structure they're building made to last, or is it just a fancy new facade on a very old building? We're going to tear it down today, brick by brick.
Okay, let's get right into it. The headline coming straight from CEO Antonio Neri really says it all, one of our most profitable quarters on record. Now, when a CEO leads with profitability, not revenue, not growth, but profitability, that tells me everything I need to know. It tells me they are disciplined, they are managing their costs with an iron fist, and they are executing their plan to turn every single dollar of revenue into real hard earnings for shareholders. In a market this volatile, profitability isn't just nice to have, it is the ultimate suit of armor. This right here is the bull case in one single sentence. This is what we look for: cold, hard, profitable results.
Whoa, hold on a second there. Profit is fantastic. Nobody's denying that. But you can't squeeze blood from a stone forever. Let's be real. The market, Wall Street, they were looking for about $9.43 billion in revenue. HPE came in at $9.3 billion. Now, you can say it's a slight miss, but in this market, a miss is a miss. And when you actually lift the hood and look at the engine, their legacy cloud and AI business, the original foundation this whole company was built on, is actually shrinking year over year. So the big question we have to ask is this: are these record profits a sign of a healthy, growing, vibrant business, or are they just a masterpiece of financial engineering designed to hide some pretty serious structural decay?
And that, right there, is the core tension we're going to unpack today. So here's our blueprint for this analysis. We're going to start with those headline numbers and see if it was really a beat. Then we're going to inspect this massive new networking superstructure they built. After that, we'll stress test that cloud and AI foundation for the very cracks you're talking about, try to unravel this whole GAAP versus non-GAAP puzzle, and finally, we'll look at management's own blueprint for the future before we deliver our iron verdict. All right, let's get to work.
All right, first things first, the headline numbers. Wall Street sets the bar, and we're here to see if HPE actually cleared it. And maybe more importantly, how they cleared it. This is always the first stress test of any company's quarterly strength. Did they come out of the gate strong and meet expectations, or did they stumble right away?
Now, what's really fascinating here is the story this table tells. Just let your eyes go directly to that non-GAAP earnings per share, 65 cents. The street was only expecting 59 cents. That's not just a beat, that is a powerful, powerful statement of operational excellence. A 32% year-over-year jump in earnings is absolutely massive. This tells me that the big Juniper acquisition isn't just tacking on revenue, it's adding highly profitable revenue, and management is executing that integration plan almost flawlessly. I see the earnings beat, and look, it's strong, it's impressive, but my eyes are glued to that top line. Revenue of $9.3 billion against a $9.43 billion estimate. It might seem like a small rounding error, but in this market, growth is paramount. You can't just cost-cut your way to greatness forever. Sure, 18% year-over-year growth looks amazing, but it's all because of the acquisition. If Wall Street was expecting even more than that, it tells you the underlying organic business might be even weaker than we thought. The market punished them for that miss, even if it was slight.
And this quote just brilliantly illustrates the company's focus. The CFO, Marie Myers, she isn't pounding the table about revenue. She's talking about delivering on commitments, about exceeding profitability and exceeding cash flow measures. This is the language of a company that is laser-focused on building a durable, resilient financial structure. They generated $708 million in free cash flow this quarter. That is the lifeblood. That's the real stuff that allows them to return capital to shareholders, $348 million this quarter alone in dividends and buybacks, and to reinvest in the future of the business. They are screaming at you, we are in control of our financial destiny.
So let's talk about the undisputed star of the show this quarter, the networking segment. With Juniper now fully integrated, this is not just another part of the business, it is the new steel frame. It's the superstructure that this company's entire future is being built upon. And the numbers here are frankly staggering. 151.5%. Just let that sink in for a moment. That is the year-over-year revenue growth for the networking segment. This is not just growth. This is a complete transformation. This is exactly what happens when you make a bold, strategic acquisition and you execute on it perfectly. This single number fundamentally changes the entire narrative and the financial profile of HPE, taking it from a legacy hardware company to a modern networking and AI powerhouse.
And if that percentage is hard to wrap your head around, this chart just makes the scale of that change crystal clear. We are going from a business doing roughly $1 billion a year ago to an absolute powerhouse, generating $2.7 billion in a single quarter. This is not some small, incremental improvement, it's a quantum leap. This is the new engine of the entire company, and believe me, it's firing on all cylinders from day one. This chart represents a complete and total reconstruction of HPE's revenue foundation.
Okay. The growth is undeniable. A $2.7 billion business appearing almost overnight is seriously impressive. But let's all just take a breath and keep our perspective here. Look at this pie chart. As absolutely massive as networking is, it's still only 29% of the total revenue pie. The legacy cloud and AI business is still the big piece here at $6.3 billion, or 68% of the company. So, while you're celebrating this shiny new superstructure, I'm staring at the foundation it's built on, which is more than twice its size and, as we're about to see, is showing some very serious signs of weakness. Can a brand new steel frame really hold up a crumbling concrete base?
That's a fair point, but let's drill down into the quality of this new structure before we condemn it. This isn't just one product line carrying all the weight. Just look at these subsegments. Data center networking revenue is up an astronomical 382%. Security is up 114%. Even the more mature campus and branch business is up a very, very strong 42%. And routing, which was basically nothing before, is now a $780 million business. This shows broad-based diversified strength. This is all the proof you need that the Juniper integration is not just working, it's creating a powerful growth engine across the entire networking portfolio.
All right, so let's talk about that foundation. We've seen the shiny new steel frame, it's impressive. But now it's time to get our hands dirty and inspect the concrete that it's actually resting on, that cloud and AI segment. This is HPE's traditional core business. We're talking servers, storage, financial services. And this right here is where my skepticism really starts to kick in. Because if this part of the business is weak, the entire structure is at risk, and it doesn't matter how strong that new networking segment is.
And this slide right here gets to the absolute heart of my concern. On the left, you see the good, what management wants you to focus on. Operating margin is up almost 2 full percentage points to over 10%. That's excellent cost control, fantastic discipline. But on the right, you see the bad, the number that really worries me. Revenue is down 2.7% year over year. It's actually shrinking. So the question for every single investor is this: how do you feel about a business that is becoming more profitable by selling less stuff? Is that a sign of strength and efficiency, or is it a sign of a business that's in a managed decline? You cannot build a skyscraper on a foundation that is actively getting smaller.
And let's break that down even further, because the contraction isn't isolated. Look at the biggest component of this entire segment: servers. It's a $4.2 billion business, and it is down 2.7%. That is the core of the core. And what about the other parts? Storage and financial services are basically flat, up less than 1%. They aren't growing, they're just treading water, barely keeping their heads up. So the main pillar of the old HPE is shrinking, and the other parts of that foundation aren't picking up any of the slack. For me, this is a major red flag for long-term organic growth.
I see the numbers, I hear you, but I think you're missing the bigger picture here. You're looking in the rearview mirror. That revenue decline is a snapshot in time. What it doesn't show you is the massive tidal wave of demand that is building just offshore. This number, over $5 billion, this is their AI systems backlog. That is $5 billion in signed, sealed orders that have not been delivered or recognized as revenue yet, and it's growing. The demand, especially for all things AI, is so incredibly strong that new orders are significantly outpacing their ability to ship. So that 2.7% decline isn't a demand problem at all, it's a supply chain and timing issue. This backlog is the steel rebar that reinforces the entire foundation, and it tells me a huge surge in cloud and AI revenue is right around the corner.
A backlog is a promise, not a payment. I'll believe it when I see it hit the actual revenue line. And, that brings us perfectly to the quality of these record profits. Management just loves to talk about non-GAAP earnings. It's their favorite way of showing success. But as serious investors, we have to look at the whole picture. And that means really understanding the massive difference between the adjusted numbers they want you to see and the officially reported GAAP numbers. So let's peel back the layers on this little puzzle.
Okay, before we dive into the numbers, it is really important to understand what we're talking about here. Non-GAAP is a standard tool across the industry. The goal is simply to allow investors to see the results through the eyes of management. You see these huge adjustments most often in the tech sector, especially with companies like HPE that grow through massive acquisitions like Juniper. The accounting rules, that's GAAP, require them to book huge non-cash charges like amortization of intangibles. Management argues, and I think fairly, that stripping these out gives you a much clearer picture of the core,
ongoing, cash-generating power of the business.
Through the eyes of management is a very nice way of putting it. I call it profitability with all the hard parts taken out. Just look at this table. This is the pro forma trailing 12 months. On a GAAP basis, the official accounting standard, HPE had an operating loss of $233 million. A loss. But after they wave their magic wand and make all their adjustments, they report a non-GAAP operating profit of over $4.1 billion. That is a swing of more than $4.3 billion. And look what they're excluding. $800 million in stock-based compensation. Isn't paying your employees a real cost of doing business? $801 million in amortization. Isn't the declining value of assets you paid billions for a real cost? And $1.6 billion in impairment charges. These are massive numbers. And while some are one-time, things like stock comp and amortization happen every single quarter. It raises a very serious question about the true underlying profitability of this entire enterprise.
Those are absolutely valid questions for any investor to ask. But, the ultimate test of a company's health isn't just the past quarter, it's the forecast for the future. This is where management puts their credibility right on the line. And HPE didn't just meet expectations for their future guidance, they blew past them. They raised them. This is the blueprint for future growth. And let me tell you, it is a confident one.
And here is the proof. They raised their full-year non-GAAP EPS guidance to a range of $2.30 to $2.50. They are now projecting full-year revenue growth in that absolutely critical networking segment to be between 68 and 73%. And maybe most importantly, they raised their free cash flow guidance. They are no longer giving a range. They're saying it will be at least $2 billion. A company that is facing a structural decline does not do this. This is a sign of extreme confidence from a management team that sees that AI backlog turning into real revenue and sees the Juniper integration delivering even more profit than they initially planned. This right here is the strongest evidence that the bull case is fully intact.
So that brings us to the final section, the iron verdict. We've examined the headlines, we've stress-tested the new superstructure, we've inspected the foundation, and we've analyzed the blueprint. Now it's time to weigh all the evidence and deliver our final structural analysis for all of you investors out there looking to forge a stronger portfolio. So here's how we see the final structure. The steel frame is a clear, undeniable strength. The new networking segment, supercharged by Juniper and fueled by massive AI demand, is an absolute growth engine. The company's financial discipline is another huge strength. The profitability and cash flow are like reinforced concrete, absolutely rock solid. But we cannot and we should not ignore the weaknesses. There is a potential crack in that foundation with the core cloud and AI segment revenue shrinking. That needs to be monitored very, very closely. And as we discussed, a full inspection is required on the financials. The heavy reliance on these non-GAAP figures means investors need to do their homework and understand exactly what is being excluded to get to those impressive profit numbers. So the iron verdict is this. HPE is a company in the middle of a massive and, critically, a profitable renovation. The transformation is absolutely real. The new Juniper-powered superstructure is not hype, it is a powerful new engine for both growth and profit. But the original foundation, that legacy server and storage business, is still settling under all this new weight. The opportunity here is for investors who believe this renovation is going to succeed, that the new structure is strong enough to carry the company forward while they shore up and stabilize that original foundation with the coming wave of AI revenue. The key is to watch that cloud and AI segment. We don't need it to grow explosively, but we do need to see it stabilize. And that leaves us with the final question for you. Is HPE truly building the next-generation enterprise tech skyscraper, the future of the industry? Or are they simply master craftsmen executing a brilliant, profitable renovation on a building whose best days might already be behind it? The materials look good, but only time will tell if the structure holds. That's your homework. Thanks for joining us here at Iron Financial, where we forge stronger portfolios.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.